July and August 2025 were anything but quiet in the world of finance. And today, we'll break down the key economic data, market trends, and major corporate headlines from these two pivotal summer months. From cooling inflation and Federal Reserve signals to stock market milestones and big IPOs, we've got a lot to cover. So let's dive in. July brought encouraging news on the inflation front. US consumer price growth continued to moderate. The all-item CPI rose about 2.7% year-over-year, roughly the same rate as in June. This marked a dramatic comedown from the high inflation of recent years and put inflation just within a percentage point of the Fed's 2% target. With price pressures easing, the Federal Reserve opted to hold interest rates steady. In its late July meeting, the Fed kept its benchmark federal funds rate at 4.25 to 4.50%, unchanged for the fifth straight time. The central bank noted that while the economy had moderated and unemployment remained low, inflation remains somewhat elevated. Notably, the European Central Bank took a similar tack. In late July, the ECB left its rates unchanged at 2%, as Eurozone inflation finally hit the 2% goal, pausing after a year of rate cuts. Overall, central bankers in July preached patience and data dependence, setting the stage for possible policy shifts in the fall. Wall Street was on fire in July. Major US indexes rallied strongly, fueled by optimism around easing inflation and hopes that interest rates might soon be cut. In fact, the S&P 500 and Nasdaq Composite repeatedly notched record-high closes during the month. By late July, the S&P 500 was up roughly 7 to 8% for the year, and the Nasdaq nearly 9%, with the magnificent 7 tech giants leading the charge. In short, market sentiments in July turned decidedly bullish as cooling inflation raised hopes that the Fed's next move might be down on rates, not up. Second quarter earnings season kicked off in mid-July, and the results gave investors reason to cheer. Corporate America mostly topped expectations, especially in the technology sector. By early August, S&P 500 companies' Q2 profits were on pace to grow over 10%, far above the modest 3% that analysts had forecast. This upside surprise was driven largely by blockbuster tech earnings. The information technology and communication services sector saw over 20% profit growth as companies capitalized on strong demand and AI-driven productivity gains. In late July, Microsoft reported stellar results, showcasing big jumps in cloud and AI-related revenues. Those earnings from Microsoft helped propel the broader stock market to new highs on July. Similarly, Google parent Alphabet and other Magnificent Seven firms signaled solid growth, reinforcing the market's confidence. As one market strategist noticed, companies were generally meeting or beating their guidance, with no major signs of weakening consumer spending or profit margins. That positive earning momentum, especially from the tech sector, was a key pillar of the summer stock rally. Even beyond tech, over 80% of reporting companies beat estimates, showing resilience in sectors like finance, healthcare, and real estate. July's earnings season turned out better than feared, and the prospect of continued growth kept investors in a buying mood. After years of IPO drought, Figma's late July debut exploded onto the scene. But the headline-worthy market reaction masked a deeper, more troubling truth about where the money truly flowed. Figma priced its IPO at just $33 per share, releasing approximately 36 million shares, most of which came from existing shareholders rather than the company itself. This amounted to roughly $1.2 billion in proceeds. But there's a catch. Figma's insiders and early investors were the main beneficiaries, not the company or public investors. Underwriting banks effectively paid early investors $1.2 billion at $33 per share, then flipped those shares to the public. Figma shares opened near $85 and briefly spiked as high as $136, pocketing an estimated $4 billion in margin on the spread, delivering a jaw-dropping 250% rise. Yet that initial pop meant that those who sold at $33 really missed out. One of the biggest losers? The Marin Community Foundation, MCF Gift Fund, a non-profit that had been gifted 13.4 million shares by Figma co-founder Evan Wallace just before the IPO. They sold for $33 each, netting $440 million, but on opening day prices, those shares were worth an astounding $1.4 billion. In effect, the foundation left nearly $1 billion unrealized, money that could have supported wildfire relief, flood recovery, and other crucial causes. In short, it wasn't just greed, it was structural. The IPO process locked in a low price, benefiting insiders and financiers while depriving public sellers, and even a philanthropic institution of billions. As August unfolded, all eyes in the financial world turned towards the Federal Reserve's next moves. With inflation trending near 3% and signs of economic cooling, markets grew increasingly confident that the Fed would finally start cutting interest rates as early as the September meeting. In mid-August, consumer prices rose only 0.2% on the month, and annual inflation came in slightly below forecasts. The Federal Reserve itself, while not meeting officially in August, gave plenty of signals. Fed Chair Jerome Powell's high-profile speech at Jackson Hole at the end of August was especially anticipated. It would be Powell's last appearance at this annual central banking symposium before his term ends in 2026. In that August speech, Powell struck a cautious, balanced tone. On one hand, he acknowledged that inflation was still roughly 1% point above the 2% target and could even tick higher in the near term. This suggested the Fed couldn't declare mission accomplished on inflation just yet. On the other hand, Powell noted that the economy had cooled and the job market was showing hints of loosening, raising concerns about rising unemployment if policy is too tight. Powell emphasized that the Fed would remain data-dependent. Essentially, they'd be cautious and flexible, not committing to cuts until necessary. With inflation much lower than a year ago and growth slowing, the door was wide open for the first rate reduction in years. August also brought a slate of corporate earnings, mergers, and oddball headlines. One notable winner was Amazon, which in August announced a major expansion of its same-day grocery delivery service. On the flip side, upstart restaurant chain Carver, which had IPO'd in June, posted a disappointing earnings report, sending its shares down 17%. In the meme stock-style realm, a newly merged entertainment company, Paramount Skydance, inexplicably jumped 40% in one day on no news, showing that speculative frenzy still lurks beneath the market surface. And in a surprising tech story, Google got a strange proposal. An AI startup called Perplexity offered $34.5 billion in cash to buy Google's Chrome web browser. Alphabet stock ticked up on the offer, though analysts scoffed at the idea of regulators ever approving such a deal. It was a reminder of how much the AI boom is shaking up industry norms, even prompting startups to make audacious bids for pieces of tech giants. On the international stage, several developments in July and August had financial markets' attention. Trade tensions and negotiations were front and center. Notably, the US and China managed to keep a lid on their trade war over the summer. In mid-August, the two countries agreed to extend a tariff truce by another 90 days, avoiding a scheduled snapback to extremely high tariffs. This truce extension was crucial. It prevented US tariff rates on Chinese goods from jumping to punitive levels, which in turn gave Chinese manufacturers a bit of breathing room. The respite showed up in trade data. Chinese exporters rushed to ship goods under the truce, and US importers were relieved not to face another price shock. However, China's overall economic picture in July and August was far from rosy. In fact, China's economy experienced its weakest month of the year in July. Growth in factory output and retail sales fell to their lowest rate since 2024, missing expectations and underscoring a loss of momentum in the world's second-largest economy. A combination of factors hit China. President Trump's tariffs, even with the truce, continued to pinch exports, the domestic property market remained in a slump, and consumer confidence was shaky. Meanwhile, in the oil market, an interesting dynamic unfolded that affected inflation expectations. The OPEC Plus alliance of oil producers, led by Saudi Arabia and Russia, made large output hikes throughout the summer in a bid to regain market share. In early August, OPEC Plus confirmed a hefty increase of 547,000 barrels per day for September, accelerating their reversal of previous production cuts. One might expect such supply boosts to push oil prices down, yet crude oil remained stubbornly high, hovering around $68 to $70 per barrel in August. In fact, Brent crude was up from its springtime lows due to steady global demand and low inventories. As summer 2025 comes to an end, investors and policymakers alike were digesting an eventful 2 months. In the US, the narrative was largely positive. Inflation had cooled significantly without derailing growth. The Federal Reserve was on the cusp of shifting to rate cuts, and stock markets surged to record highs on the back of strong earnings and renewed risk appetite. We saw the return of IPO excitement with Figma and others, even if not without volatility. And we were reminded that challenges remain, from corporate scandals that test governance to global economic headwinds in places like China that could eventually circle back to American shores. The late summer pause in the market rally showed that investors aren't complacent, but rather weighing each new data point in a very fluid environment. All eyes now turn to September and the fall. Will the Fed deliver that widely expected rate cut? Can the stock market euphoria sustain if earnings or economic data cool off? How will international issues, whether a Louis Vuitton legal saga or China's stimulus efforts, play into the global financial picture? One thing is certain. After a hot summer for both temperatures and markets, the stage is set for an eventful autumn. Stay tuned as we continue to monitor these stories and more in the months ahead.